At the end of 1999, Microsoft was one of the most profitable and dominant companies on earth. Over the following 14 financial years, it would generate nearly $190 billion in cumulative net income. Its revenue would more than triple. And yet, for an investor who bought close to the dot-com peak, Microsoft's share price would spend roughly 14 years failing to get back to where it started. Microsoft was not a bad company. It was an excellent company bought at a price that assumed almost nothing could go wrong. And when investors eventually stopped believing that Microsoft owned the future, its growing profits were not enough to save the stock. The reason becomes clearer when you reduce the stock price to two basic components: the amount of money the company earns and the valuation investors are willing to place on those earnings. Imagine a company earning $1 per share, valued at 80 times earnings. It would trade at $80. Now imagine that company triples its earnings to $3 per share. That sounds excellent, but if investors are now only willing to pay 15 times earnings, the stock would trade at $45. The company has become 3 times more profitable, but the stock has fallen by almost half. That is essentially what happened to Microsoft. At its 1999 peak, Microsoft was valued at approximately $621 billion. Against fiscal 1999 net income of around $7.8 billion, that implied a rough valuation of almost 80 times earnings. By 2013, Microsoft was earning close to 3 times as much, but its shares were valued at only around 13 to 15 times earnings. The profits grew, but the expectations collapsed. To understand why investors paid so much, you have to understand what Microsoft represented during the 1990s. Windows controlled the operating system on the overwhelming majority of personal computers. Office had become the standard software package for businesses, and every new computer sold created another potential Windows license, another Office customer, and another developer building software for Microsoft's ecosystem. This created a powerful feedback loop. More people used Windows because more programs were available for it, and developers built more Windows programs because that was where the users were. Microsoft's financial results appeared to justify the enthusiasm. Revenue grew by 29% in fiscal 1999. Net income reached almost $7.8 billion on revenue of just under $20 billion. That was an extraordinary level of profitability, but the market did not simply price Microsoft as an extraordinary company. It priced Microsoft as though extraordinary growth could continue for years with very little interruption. That distinction matters. A high valuation is not merely a compliment, it is a demand. The higher the valuation, the more growth a company must deliver just to justify the existing share price. When the dot-com bubble burst, Microsoft did not suddenly stop making money. In fiscal 2000, its revenue still increased to almost $23 billion, while net income rose to more than $9.4 billion. But revenue growth had slowed from 29% in fiscal 1999 to 16% in fiscal 2000. Microsoft was still growing, it just was not growing quickly enough to support the expectations embedded in its valuation. The company also faced a major US antitrust case, weaker PC demand, and the wider collapse in technology valuations. Microsoft's pre-split share price had reached almost $120 at the end of 1999. After accounting for its later stock split, that peak was equivalent to roughly $60 per share. By the end of 2014, Microsoft was still trading below that level. This does not mean shareholders received literally nothing. Microsoft began paying regular dividends and distributed a special $3 dividend in 2004. Buybacks also returned capital to shareholders. The term dead money is therefore shorthand for the stagnating share price and enormous opportunity cost rather than a claim of precisely zero total return. But the central contradiction remains. The business continued expanding. Fiscal 2000 revenue was around $23 billion. By fiscal 13, it had reached almost $78 billion. Net income increased from approximately 9.4 billion to almost 21.9 billion. Across those 14 financial years, Microsoft generated roughly $190 billion of cumulative net income. And yet the market value of the company remained far below its 1999 peak for much of that period. The problem was not that Microsoft's existing business had disappeared. Windows and Office continued producing enormous amounts of cash. The problem was that the center of technology industry was moving. First towards the internet, then search, then smartphones and tablets, and eventually cloud computing. Microsoft remained dominant on the traditional personal computer, but the personal computer no longer appeared to control the future of technology. Apple controlled the most influential premium smartphone. Google searched and developed Android. Amazon was building an early lead in cloud infrastructure. Meanwhile, Microsoft was spending heavily trying to establish new positions. Its online services division, which included Bing and MSN, reported an operating loss of approximately $1.3 billion in fiscal 2013. In 2012, Microsoft recorded a $6.2 billion impairment, mainly connected to its acquisition of online advertising company aQuantive. In 2013, it also recorded a $900 million charge related to unsold Surface RT inventory. None of these losses threatened Microsoft's survival. The Windows and Office businesses were far too profitable for that, but they reinforced a damaging market narrative. Microsoft could generate cash from the previous era, but it was struggling to prove that it would lead the next one. This is where Microsoft's story is often oversimplified. Steve Ballmer did not preside over a collapsing business. During his period as chief executive, revenue and profit increased substantially. Microsoft expanded its enterprise server business, built Xbox, and began investing in technologies that eventually would become Azure and Office 365. The financial position remained extremely strong. The strategic position was what investors questioned. Microsoft had quality. What it lacked was a trusted next act. The foundations of Microsoft's recovery appeared before the share price fully responded. Windows Azure became generally available in 2010. Office 365 launched globally in 2011. These products gradually changed the economics of Microsoft's business. Traditional Microsoft depended heavily on selling software licenses linked to corporate purchasing cycles and new personal computers. Cloud Microsoft could sell computing capacity, databases, storage, security, and productivity software as continuing services. This mattered for three reasons. First, subscription revenue was recurring and more predictable. Second, cloud services were not limited to the number of new Windows PCs being sold. And third, Microsoft already had decades of relationships with the world's largest companies. It did not need to create an enterprise customer base from nothing. It needed to move that customer base from software installed on company-owned computers to services running through Microsoft's data centers. At first, the cloud business was too small to transform how investors viewed the company. Microsoft reported commercial cloud revenue of around $700 million in fiscal 2012 and $1.3 billion in fiscal 2013. Promising, but still tiny beside Windows and Office. The market needed evidence that cloud computing could become Microsoft's next growth engine. Then, the leadership changed. Cloud computing did more than add revenue. It changed what investors believed Microsoft could become. During the stagnant period, earnings increased, but the valuation multiple contracted. After the cloud transition became credible, earnings increased and the valuation multiple expanded. That combination is far more powerful. Microsoft had moved from a mature PC company defending its old monopoly to a recurring revenue platform with exposure to enterprise cloud growth. The market became willing to pay more for each dollar of Microsoft's earnings because those earnings were now viewed as more durable, more predictable, and capable of growing for longer. Microsoft did not suddenly become a good company in 2014. It had been a highly profitable company throughout most of the previous decade. What changed was the relationship between quality, price, and expectations. The valuation was no longer starting at the extreme level reached in 1999, and the company finally had a new growth story investors could measure. Microsoft's lost decade teaches a lesson that is easy to repeat and difficult to follow. A great company is not automatically a great investment. The return depends on what you pay and what the market already expects. If the stock is priced for flawless growth, merely producing good results may not be enough. The company can increase its revenue, it can increase its profit, it can remain the market leader, and shareholders can still earn disappointing returns while the valuation falls back towards reality. The opposite can also happen. When expectations are low, a company does not need to become perfect. It only needs to become better than the market assumed. So before asking whether a business is excellent, ask a harder question. What future is already reflected in the price? Because Microsoft's business did not fall after 1999, the price had simply reached the future before the company did.